IMF brings out the World Economic Outlook twice a year. One comes out in April, the other one is in October. And I think given the fact that lots of things have been happening in the world economy as well as in the domestic economy, I think we thought that would be the opportune time to actually try and analyze as to what exactly the IMF feels about what is happening around us in the world, how that could be affecting us here in India, and how much of weightage should we actually be placing on what the IMF has got to say. Now, we should remember that IMF is a multilateral organization, just like the World Bank or the Asian Development Bank. And this is one set of forecasts, one kind of view which is given on the overall state of the world economy. And since this came out in October, we had we also had the World Bank coming up with their outlook on the economy. We had the ADB coming up some time back. We had the OECD coming also with their forecast. And then, of course, we have the Reserve Bank of India, which tells us as to what is happening in India, as well as what is happening in the global economy. Of course, what the RBI normally talks of the global economy is references to what other agencies which normally cover the global economy in detail. I think they normally talk about what other people are saying, and then they give what's happening in India. So how much should we actually be paying attention to the IMF? I think it's a very important piece of information which we get. And that's why we're having this presentation here today, to tell you exactly as to what the IMF feels is happening around us. Now, just to give you a kind of a background, this particular calendar year started off with the Ukraine war, which has created quite a bit of distortions or disruptions in the global economy. We saw supply chains getting affected once again after the COVID and the accompanying lockdowns, which happened in the years 2020 and 2021. Similarly, we also saw that since the world economy had recovered quite sharply in 2021, we had seen that global commodity prices had started increasing. And at this point of time, we also saw that central banks across the world were worried about what was going to happen to inflation. So accordingly, we have seen central banks all talking about increasing interest rates in order to curb inflation. And we in India are actually worried about inflation being around 7%. But if you look at some of the countries in Europe, you look at US, we're actually having inflation rates in the region of 8 to 9%, or even more. So therefore, inflation has become a kind of a global phenomenon. And I think the response of most countries through the central banks has been to increase interest rates. Now, what happens when interest rates are increased? There is a tendency for everybody to get affected. So we have seen that when interest rates started rising in the US, there was a tendency for the dollar to strengthen. And as the dollar started strengthening, we saw other currencies weaken. And the rupee also was not immune to it. And just yesterday, I think we touched a new low of 83 rupees to a dollar. And while there's been quite a bit of anxiety about what is going to happen to the rupee, which we'll talk about in the course of the presentation, the fact is that as long as the dollar keeps strengthening, there will be a tendency for all currencies to weaken. We cannot really escape that. In fact, if there's too much of intervention that comes from the central bank, we may just end up losing our forex reserves, and we may just see the rupees continue to decline. So this is generally a feeling which is there with most countries. I think central banks across the world have tried to intervene at different points of time by selling their foreign currency in the market to stabilize the currency. But this hasn't really worked. It cannot be a long-term strategy. And I think we are in this unique phase of in this unique phase where I think currencies are just going to find their own level. And how the challenge for players in the market is, how do you actually counter it? What kind of hedging opportunities do you take up? What kind of strategies do you really build up to make sure that you get insulated to the extent it's possible through whatever these strategies are? So we have a situation here where all the prices seem to be going up. And I say prices, there are three basic prices. One is commodity prices denoted by inflation, currency prices denoted by the exchange rate, and price of capital, which is denoted by interest rates. So we in Bank of Baroda, we in the banking sector are obviously concerned when interest rates go up as to whether this is going to actually impact the flow of credit, which it will be impacting the overall growth rate. Now, here an interesting thing is that when central banks across the world are increasing interest rates, what are they trying to do? They're trying to slow down the overall pace of the global economy so that you will actually see lower growth rates, what people are calling very loosely a recession. That's what Aditi will take you through as to what exactly we mean by these numbers. But when the economy starts slowing down, the American economy starts slowing down, and the Federal Reserve actually stops increasing rates. Today, they're talking of the Fed rate going up to say 4.4 or 4.6% next year. Now, once that happens, there will be reason for one to believe that there'll be a reversal in terms of the fortunes of the dollar. And as the dollar starts weakening, then there could be some bit of sanity which comes into the forex market across the world. And therefore, we could also see the rupee probably appreciating at that point of time. But of course, right now, it's very much conjectures. I think we as economists try to understand what's happening. We try to explain to you all, give forward our view. But we have realized that once too often we are proved wrong, because the kind of developments which are taking place are much faster and something which we have never seen in the past. So it becomes a bit difficult for one to really make projections on currencies, on interest rates. But we will try our best to give you what we feel as of today is how we look at the global economy as well as the domestic economy. And as we go through this presentation on the World Economic Outlook, do feel free to chip in and give your own views at any point of time. We have tried to stay honest to what the IMF has said in their report. So most of the views which are given out here are exactly what the IMF is saying, so that we know what the global view, the institutional view is. And towards the end, of course, we are trying to juxtapose our own view in terms of how will this really be affecting us sitting in India, which we can actually further extend to say as to how we in the banking sector could also be affected. And here I would request Aditi to start with the presentation. Thanks.
Thank you, sir. So we'll now start with the presentation. So first and foremost, we'll just have a look at the growth forecast. So like sir has mentioned that right now what we are seeing is, there is a lot of talk being about the term recession. So, but in technical terms, recession is defined as 2 consecutive quarters of negative growth. But what we have seen right now, people are using recession to denote a slowdown in growth. So during this period, there is a slowdown in growth, unemployment is inching up, and demand impulses remain very weak. So the result is that the overall price pressures, they decline. So in their report, IMF has mentioned that there is a marked slowdown in growth in 2023. So from 3.2% in 2022, global growth is expected to decline to 2.7%. And the IMF notes that the worst is yet to come, and for many people, 2023 will feel like a recession. So if you look at the growth forecast, we see that there is a considerable slowdown in growth in the advanced economies. So this comprises of the US, Euro area, and other such countries. So for advanced economies, the growth is estimated in 2023 at 1.1%. Even for emerging market and developing economies, the growth forecast has been revised lower. So in the Euro area, in many countries, like most importantly in Germany, we actually see a contraction in growth in 2023. In emerging market and developing economies, the lower growth is mainly due to China. So China's growth forecast has been revised relatively lower. So we will discuss in detail about the factors which are affecting growth, and that will take you through the course of this presentation. Another important information in the IMF World Economic Outlook is the inflation forecast. Now, inflation has gained a lot of attention in the present context. So in several advanced economies, we have seen that inflation is running at a rate of above 8 to 9%. So, and this is much above the mandate of their respective global central banks. But the good news is that the IMF is saying that global inflation is expected to peak to 8.8% in 2022 and decline to 6.5% in 2023. While there is this moderation, even then inflation remains stubbornly very high. In 2024, inflation projection is at 4.1%. We can see that the emerging market economies are having a much higher inflation rate than advanced economies. So now we will discuss the major threats to the world economy. So first and foremost is the Ukraine war. So the Ukraine war has gone on much longer than we had earlier anticipated, and in recent time there are signs of further escalation. So this has resulted in a lot of supply chain mismatches, and it has also pushed up prices of important commodities such as food prices as well as oil prices. The second and another important aspect is the slowdown in China. So China has been grappling
Aditi, let me just interject here. Sorry if you don't mind. See, when you're talking of the Ukraine war, we're talking of the energy crisis. I think this is significant because if you actually see that Russia is one of the major suppliers of gas to Europe. So if you look at Europe, I think one of the major sources of energy is gas. And they've been getting it also cheap from Russia. Now, with these lines being blocked and Russia threatening to turn off the taps, increase the prices, now what's really happened is that as we're approaching the winter months, Europe will have to look for alternatives in terms of getting energy. So today, when we're talking that Europe has been one of the leading continents when it comes to climate change and trying to become greening the economies, today we have seen that they will have to move over from gas to something like coal because they will have to substitute gas with electricity produced from coal. So that's one thing which is happening. And as a result of it, we've also seen that the price of fuel has gone up, price of power has gone up, and this is creating problems. So I think you might also have read about what's happening in England, where we had the new prime minister who came up, and the whole idea was that we'll try and pay up for your energy bills. Now, what exactly are you talking about the energy bills? The energy bills which is being spoken of is primarily the bills which are rising because of the cost of electricity going up, the cost of gas going up. You can carry on.
So we were talking about China, that in China, there has been a resurgence in COVID-19 cases recently. And China's strict COVID-19 policy has ensured that there are strict lockdowns and movement of people is severely curtailed. So that is hampering growth. Other than that, there is an ongoing property crisis, which is threatening growth in the region. Then the third point is inflation. We have already discussed that a high inflation is going to erode the purchasing power and demand is likely to suffer. So this is also an important threat to global growth. Now, another related point is central banks have been raising rates to control the rising inflation. Now, this is also likely to have a dampening effect on growth as investment growth and will stall. Like we have already mentioned that 1/3 of the countries are likely to contract. Among them, major economies like Germany, Spain, Italy, these are, IMF already predicts that these are going to contract in 2023. So major economies like, even in major economies like China, US and Euro area, growth is likely to stall due to various reasons. Another thing is that there is also a threat of new strains of COVID-19, and monkeypox has also risen in several countries, and which will and if it leads to restrictions like COVID-19, it will also have a dampening effect on growth. So we will now discuss the focus points as mentioned in the report. So again, the foremost is the China factor. So despite criticism, China has upheld its zero COVID policy, which involves strict lockdowns and movement to prevent the spread of disease. There has been a resurgence of COVID cases in several key industrial cities, which is impacting growth and production in the country. Now, China is also a very major player in the global economy, and it is a huge importer. So a slowdown in growth in China will have an impact on global demand, and export-oriented economies will particularly be impacted most. Now, another thing is the property crisis in China. So, real estate is an important sector for China and accounts for about 25% of China's GDP. So, in recent time, we have seen that because of the crisis, housing prices have fallen and housing demand has also declined. So, there is a threat. Now, builders are highly indebted, and there is a threat that this could spill over to the financial sector as well. So, that is also a looming threat to the growth.
Just one thing out here. See, when we are talking of China, we know that China has been one of the fastest growing economies since the 1980s. And it was only in the last few years that we have seen a slowdown. Now, one thing is that we have seen that the Chinese growth model itself was something which was considered to be unsustainable. Why do we say unsustainable? Because it was a model based on large amount of investments being made in infrastructure. So that was able to generate this high double-digit growth rate on a sustained basis for over 2 decades. But now there's a whole question of saying that can this model actually be sustained? Now they've reached a situation where consumption has not been increasing because of the same kind of challenges that we have here in India, where we don't have a large amount of jobs being created, incomes being generated, and consumption going up. And therefore, there was some kind of stalling of the Chinese growth. Now, in this kind of a situation, we've also seen that there are political issues which have come up. And this is not what the IMF is saying. This is what we are saying. So this should not be taken as an IMF view. That when we have governments which are generally self-serving, looking more at their own interests, making sure that the regime continues to prevail in future also, this has also come in the way in terms of fostering growth. Why do I say this? Because if you see the focus which China has been placing now on growth in terms of creating more jobs for people, making sure that even the demographic dividend which they have lost, because now China has a problem of an aging population. How do you actually reverse it? So the same advantages which are there earlier are no longer advantages, they become disadvantages. So in this kind of a situation, you need to have a very positive, affirmative political regime to make sure that you have the right economic policies in place. And if one goes back over the last 4 or 5 years, there's been not any major change in your policies. They're just carrying on the way they are. Even the property crisis, something which was there even 2 years back. If you remember, we had the Evergrande crisis. The only thing is it's gotten widespread to almost the entire property sector, the real estate sector, which is creating these kind of problems. And the last point, which Aditi had mentioned about high indebtedness, is actually a very significant problem. We also saw in India also when we had the indebtedness problem, the NPA problem in 2015-16. It's taken us almost 5 years to get out of it. Now, right now, when we see a case where both corporates as well as individuals are all going to be possible NPAs in China, that can be a kind of a major problem for them. And once you have a problem on the financial side, it has been seen right from the Lehman crisis, or even if you go back to the Asian crisis, to Lehman crisis, to the Evergrande crisis, the moment or the Indian problem itself, we've seen that once you have a financial sector crisis, it can actually slow down the growth further. So I think it's against this context that lots of people, lots of analysts are today saying that, can India take on the role of China? Can India be the next big market for Western economies, where people do focus on looking at India as a kind of an alternative to China, both from the point of view of investment, as well as the fact that can India actually flood the market with goods so that we are able to sort of just make sure that our exports increase and also become part of major global supply chains. I think that's what the PM and FM have also been talking about regularly. And that's the context, because we're talking of the decline of China, possible decline of China. We can't take this for granted, but in case China does falter, they are no longer able to get back to this high growth path, which I personally believe will take another 5 to 6 years for them. Then there is obviously an opportunity which is there for India. You can carry on, Nathan.
The next point that Sir also briefly touched upon is the dollar is getting stronger. So the reasons behind the dollar getting stronger, one and the foremost reason is that US Fed has been at the forefront when it comes to raising rates to combat inflation. So as a result, dollar has appreciated, and it has appreciated close to around 18% this year. So this has put pressure on other currencies. So when the dollar strengthens, it also leads the problem of imported inflation in other countries. So that is also feeding into inflation in other countries, and in particular, EM countries have been affected the most. Yeah. So next is the problem of inflation. We have discussed earlier that higher inflation has been one of the reasons behind this high inflation is due to the lingering impact of the pandemic. So as the economy is recovered from the pandemic, the demand for goods and services increased at a much faster pace than was earlier estimated. Furthermore, there was a lot of fiscal support being given to support growth, which also led to a high recovery in demand. Now, another reason was the Russia-Ukraine war, which created several disruptions and led to higher prices, especially for energy prices. So we have also seen that demand for services has increased due to the pent-up demand, and especially for tourism sector, the prices have been very high. So on the aspect of food prices, there is also some climatic things at play. So high heat in several countries has also led to disruptions in the markets, and that has contributed to higher inflation. Apart from this, core inflation is also expected to remain high due to pass-through of higher energy prices.
Just to add something out here, see, when IMF is talking of inflation coming down next year, the major reason is that we do expect that commodity prices will continue to slow down. Why will they slow down? Because when we are talking of a global recession or a slowdown, now I'm going to loosely use the term recession to mean a slowdown, there will be a general fall in terms of demand for goods and services. So once that happens, automatically there will be a tendency for prices to come down. We have seen that prices of metals in particular, even food products like edible oils have already started moving downwards, which means that there's been some bit of relief which we have gotten from high prices, high commodity prices. And this has also been contributed by the China factor. So when we say that China is slowing down, it will automatically mean that the demand for goods will come down and prices will move down. Because China is probably one of the largest producers and consumers of virtually all commodities. So their capacity to consume is really immense. And China, in a way, is a single factor which can actually drive prices up or down. So with China expected to slow down further in 2023, this could be good news in terms of inflation for the rest of the world, though I think we will continue to face this problem, at least a country like India, in terms of imported inflation, because if the currency remains volatile, the rupee keeps falling, and the fact that India is one of the better performing economies, we still take pride in saying we are the fastest growing large economy in this current financial year. And I think we'll very much probably replicate the same situation next year too. Our imports will keep increasing because as an economy grows, the demand for imports go up. And as India imports more commodities, if the rupee continues to depreciate, automatically the case of imported inflation rising becomes more and more prominent. And that is one fear which we do have. And that's probably, one does look back at that slide of the IMF where they spoke about inflation in India. Even they are looking at inflation above 5% for 2023. So I think that would be the challenge for the RBI, for all of us in the banking sector, that even next year may not be a 7% inflation thing, but it would be in the region of 5 to 6%. We, of course, our own research shows it will be in the region of 5.5 to 6%, but above 5% is what the IMF is also talking about. Please carry on.
Thank you, sir. So next we talk about what the global central banks have been doing. So in order to combat the high inflation, most central banks have been on a rate hike spree. So Amongst major central banks in the advanced economies, US Fed has been at the forefront and it has raised policy rates by a cumulative 300 basis points this year. This has been followed by Bank of England, which has raised policy rate by 200 basis points. On the other hand, the European Central Bank it was one of the last banks to hike policy rates, and it has raised policy rates by 125 basis points. There is a policy divergence also with Bank of Japan keeping rates steady and Bank of China actually reducing rates. Now, along with rate hike, central banks have also began to curtail their balance sheet, which had ballooned during the pandemic. All major central banks such as Fed, BOE, and ECB have indicated the end of quantitative easing. This has resulted in a considerable tightening of global financial conditions.
Here, just a point out here, you see, when quantitative easing took place, what did it really mean? It meant central banks were buying up paper which was being offered by the banking system, by the financial sector. So if I was a bank and I wanted liquidity, I would offer, say, $100 billion to the Federal Reserve, and they would pay me for it in cash. Now, what did I do with this money? A large part of this money which came from quantitative easing was invested in the emerging markets. So that was one of the reasons why we had the stock markets doing very well, especially in all the emerging markets, and India benefited a lot. And we also saw lots of FPI money coming in to both the equity as well as the debt segments. So I think this was the major benefit or the collateral benefit which we had when there was quantitative easing. But this also means that once we go into quantitative tightening, which means that central banks are going to roll back the balance sheets. So to begin with, they say that, okay, whatever, no new bonds are going to be bought. Second, they say that right now they're saying that whatever expires, that is whatever matures, that will be renewed. Soon they're going to stop that part. And very soon, the third stage will be where they'll actually start saying that that's the end of it. So once everything has matured, there will be no fresh money in the system. This will also mean that the turmoil which is there in the global system is that as funds are being withdrawn, there will be, again, second round of action or second round of reactions or impact on emerging markets where we will see a flight of capital. First, it will be a case of saying there'll be fewer funds of FDI or FPI coming to India. Second part will be that there will be people who will probably say that let's go back to our own country because interest rates have gone up in the US. So therefore, it makes sense for us to invest now in the US. So this is exactly what we have seen in terms of FPI behavior in the last couple of months, where they were very buoyant in the months of July and August, September, October, fairly volatile, at times going down, times going up. But one can foresee a situation that as the Federal Reserve finishes all their rate hikes, interest rates reach something like 4.5% out there, quantitative tightening in place, the fund managers may just decide that American economy is now the place to invest, and emerging markets will get secondary preference, in which case there can be a flight of capital. So that's the reason why I think even central banks, especially Reserve Bank, will also be concerned that if such a situation does materialize, you'll again have a second round impact on the currency. So today we see the currency is going down because the dollar is strengthening. Nothing we can do about it, but there could be a situation where we could see a reversal or slowdown in terms of capital flows, foreign investment flows. That will be another thing which all central banks across the emerging markets will have to keep in mind. Yeah, please go ahead.
So the next aspect is of the impact on global trade and external position. So as per the IMF, global trade is expected to slow down markedly in 2022 and 23 from 10.1% to 4.3% in 2022. So we have already mentioned that one of the major reasons behind this will be the slowdown in China. Again, China has, apart from being a huge importer and as well as exporter, it also has an important place in the global supply chains. So a slowdown in China is likely to affect the overall trade, overall global trade. Also, because the global slowdown, due to the global slowdown, demand is also likely to taper off. Another factor is the dollar appreciation. So Despite a decline in global trade, IMF expects trade deficits to expand. Now, this is the reasons behind this is due to, again, like Sir has also mentioned, that imports are likely to increase as economies are growing and as they are recovering from the pandemic. And another reason is higher commodity prices. But in this respect, if the commodity prices, the trend of moderation sustains, we might not see a significant expansion in trade deficits. So I would now like to call my colleague Janvi to take you through the rest of the presentation. Thank you.
Hello and good evening, everyone. Madan sir and my colleague has already mentioned about the outlook that IMF has given, right? And what are the shocks that were associated with it, and the reasons behind calling global slowdown and inflation is a main concern. I'll be taking you and talking about what are the risks to that outlook, and is it like those risks are they more pronounced on advanced economies, or it has to do something with the emerging economies too? So starting off with what are the risks to the outlook. Central banks, of course, are in a conundrum like what to do. The main idea, the mandate is most of the central banks is to maintain price stability. But if they are not able to do that, they are on the extreme ends. If they are under tightening and under tightening the policy, that will result into entrenching of inflation, right? And will also erode their credibility as central banks with the mandate given to them to maintain price stability. On the other hand, of the spectrum is over tightening. If they go on into rate hike spree, which most of the central banks currently are doing, but of course they are also watchful and are monitoring it, because if they do over tighten the monetary policy, it will also have an impact on growth, and they would not want to do that. The slowdown would be inevitable, and as mentioned, there might be a possibility of recession also. Like my colleague had mentioned in the beginning, there has been some amount of a policy divergence. While most of the global banks have been on a rate hike spree, you name it, be it Fed, be it ECB, be it Bank of England, be it Bank of Canada or Australia for that matter, there are some central banks who are not doing it. For example, Bank of Japan is not doing it, but it's important to understand they have an underlying issue of low inflation, so they are tackling that. Then we also have PBOC, the Central Bank of China, which is now rather focusing on growth. Because of a lot of COVID-19 restrictions that are still continuing and the property crisis that it is still undergoing, the focus of the country is right now on the growth. So there has been a lot of policy divergence at play too.
Just one intervention here, Janvi, sorry. See, when you're talking of policy divergence from Fed can be disruptive. Now, all the time, the Reserve Bank of India has always maintained that monetary policy is a decision taken based on domestic considerations. And the RBI always, however, sees what other central banks are doing. But in the last policy, I think a significant statement made by the governor was that there have been three shocks which we're all going through. One is, I think, spoke of COVID. The second was Ukraine. And the third he mentioned was the Federal Reserve. So I think now, given the fact that almost all investment decisions, investment flows are all being guided by what's happening in the US, it becomes quite mandatory actually for most central banks to react to what the Federal Reserve is doing. So if you look at the way in which the RBI has also been increasing rates by 50 basis points, to begin with, I think when our department was making any kind of a projection about what the RBI would be doing, we felt it would be 25, 35 basis points. But now we see that it will have to be something like 50 basis points because you need to keep pace with what the Federal Reserve is doing. And the Fed is going all out in terms of a 75 basis points increase in rates. So in this kind of a situation, if you are not as aggressive as the Federal Reserve, then one really doesn't know what will be the consequences. So when we say that policy divergence from Fed can be disruptive, this is exactly what's being pointed out too. Even today, for example, when the monetary policy minutes came out for the last policy, I think a couple of members wanted a lower quantum of increase in the repo rate, but finally the majority said 50 basis points. Now, when we're going, the whole question will be that, do we still have a 50 basis points increase, or will it be a 25 basis points increase? And in between, I think there would be another federal policy. So if the Fed is going to meet again and we have another 75 basis points coming up, then it may become almost axiomatic for the RBI to also respond with a 50 basis point rather than a 25 basis point. So these are just possibilities I'm talking of, but it's become very much important today for everybody to track what the Fed is doing, because if we don't do that, it's not just a case of saying about movement of funds, but there will also be the case of what happens to the currencies. So virtually everything happening in the bond market, everything happening in the currency market will finally can be traced to what the Federal Reserve is doing. That's the reason why there has to be a convergence in what most of the central banks do and keep it towards what the Federal Reserve is doing. Please, Karen.
Okay, on the second aspect, there is IMF also felt that halting of gas supplies to Europe will be of a prominent challenge. As of now, the Russian gas supply to Europe is down by 20% compared to last year levels. And if there is a possibility that all the entire gas supply is being cut down, of course, it will lead to energy crisis. The prices are going to shoot up, and the impact would largely and morely intensely would be felt on the consumers and the businesses. Now that we have understood what have been the risks to the outlook, it's important to understand how the countries have, what the kind of risks that the countries have been facing. And is the debt a challenge? Of course it is. If we look at the charts on the right-hand side, you'll see that these are the sectors or the groupings that have been done by IMF, where it's being done on the basis of the sovereign spreads. With the war in Ukraine, the sovereign spreads have risen up. And based on that, if you see the two categorization, the distressed group is the one where the sovereign spreads are greater than 1000 BPS. And on the other hand, the stressed one is the one when the spreads are between 700 to 1000 BPS points. If you see for the stressed one, the total weighted average debt to GDP ratio is around 57%. On the other hand, for the distressed one, it is ranging between 47%. Why is it important to talk about this growing stress is because of the Ukraine war, these spreads have gone up. But imagine this is during the time when the countries have been facing the global pandemic also. They are rolling through that crisis in itself too. And on top of this, the spreads have gone up. And what has this resulted in? This has resulted in the rates have, the market, the interest rate, international rates have gone up across the board, which has made funding a big challenge for all of them. The borrowing costs have gone up. Also, on the next slide, there has the impact.
Janvi, sorry to interrupt. Can you just go back there? See, now the basic idea here is that there are quite a few countries who borrow in the international markets to meet their budgetary requirements. So therefore, if the federal rate goes up, automatically my cost of borrowing goes up. But if you know, like we all know, as far as India is concerned, the Indian government debt is purely in rupees. So therefore, we should not be getting affected by this. This is what the initial impression is. But the more important part is that for us working in a bank and for us dealing with our clients, I think the major concern today will be that lots of companies in the past have been borrowing in the international market, the external commercial borrowing route. And the reason people were borrowing was because interest rates were much lower. Rupee was very stable. So therefore, there was an advantage in borrowing from international markets. Now, today, for example, most of the companies which are borrowing from overseas markets will suddenly counter higher interest rates. And these rates normally tend to get juxtaposed with the sovereign spread. So if the sovereign spread is 200 basis points, then automatically the commercial spread will be 200 plus X or plus Y. So that is why this particular part will also be important. Debt distress may not be an issue for us as of today, but definitely companies which have borrowed on a floating rate in the international market will suddenly see that their cost of servicing the debt has gone up. And to that extent, I won't say distress, but definitely the debt burden would go up. And that would be a concern, something which even the RBI will be looking at. Not only is your cost going up because of the interest rate going up, but you will also be facing a more depreciated currency. So even the rupee value of the debt which you're holding is going to go up. So that's the kind of a disruption which is being caused on account of what the Federal Reserve is doing, on account of whatever the reasons which have been discussed. Yeah, please carry.
One of the concerns taking further on the debt distress is that, of course, with the market rates high across the globe, there will be a lot of capital outflow at play too. So, and if I'll just take an example, this is the chart on the right is for India. This has not been given by the IMF. We're just trying to show the volatility that is there over the course of a couple of months. But what IMF had pointed out is that the impact of the debt and the capital outflow would largely be felt on the advanced economy, but more so on the emerging economies. Right, like Sir had mentioned out the rationale behind the sovereign spreads, which will result because of the tighter financial condition and global rate hike cycle. There is, of course, the fear of recession that is looming ahead, and which will result in the capital outflows. I'll come back to this chart again when I talk about India at the end. IMF also in deep, they talk about and delve deeply on the price movement. So, of course, we are all aware about the fact that when the Ukraine war had started off at that time, it had resulted in a high inflation, and the impact was largely being felt on the food prices, of course, across the board, but on the commodity index as well as on the food prices. Just to give you an example, the commodity prices had risen by over 19.1% from February 2022 when the war had started till August 2022. So it's a pronounced impact in itself. In terms of oil, the oil prices have also gone up during that period. But if you see the chart on the right, it will show you that at the end of Q3, that is by December, you see this is somehow easing down. It has reached its peak point. And this is for the energy one. And by next year, it is expected to come down. So this is a similar assumption that has been taken by IMF, where they say that the oil price is expected to fall down to 98.2 by 2022 and further by 76.3. IMF is also quick to point out that there are risks associated with it, both downside and upside risks. The downside risks are prompting from the fact that there is a growing risk of slowdown in the global economy. The demand could be also subdued, again, related to China and the COVID-19 restrictions that are still being levied over there. However, there is an upside risk also to the oil prices, which would be possible because if the COVID war, the Ukraine war continues, and of course, if there is a possibility, if there are any other new COVID-19 variants, so there could be a supply side disruption that might again happen from China and to the globe. So IMF is taking both of them into account, that there might be a possibility of both these risks occurring. Coming on to the metal prices, they expect it to fall down by around 5.5%. Again, it's important that we have already been categorically talking about how China plays a pivotal role in all of these, with the precious metal coming down to 0.9. The last point I mentioned is where it's interesting to note that in the study, the IMF talks about that there is a food and oil price movement, which goes hand in hand. So interestingly enough, IMF pointed out that if one would do a correlation or one would want to see during a boom and a bust phase, I'll talk about the last part later on, but I'll talk about the food and oil prices. If one is able to draw out the number of the boom or the bust cycles from 1970 onwards, there is over a 66% chance that the food and the oil prices will move in tandem. And the number is peaked up to almost 75% to 77% if we start the cycle from 2004 onwards. So it is interesting to see this analogy being drawn on by IMF. On the other hand, if you see the table on the oil and cereal price correlation, we'll see that interestingly enough, during the period of 1970 to 2004, the correlation between the cereal and the oil prices is around negative 0.9%. So there's a negative correlation, while this number moves on to a positive correlation of 17.4%. For corn also, there is no typo. The corn is negative 2.3. And from 2005, it has gone up to a positive 23.1. It is important also to understand that during 2000s, there was a biofuel mandate that was being started off, which gave a lot of biasness, and people were being asked or being to use corn more than the other commodities. So it is quite interesting to see all of those being taken into account. Okay, now that we have mentioned how the countries have been affected, it's also important to note how overall the corporates have been affected. After the 2022 COVID-19 crisis in 21, most of the companies have emerged out, and with the recovery in place, there have been growing profits which were earned in 2021. Unfortunately, those have moderated as of now. Of course, largely it has been related to the elevated prices. The energy prices have been high, food prices have been high. We have discussed it in the previous slides also. And now with the global rate hike cycle at play, we know that the borrowing would be a tough challenge for the corporate. So this might again would be something to be watchful of. And the advanced and the EMs will be facing the housing market crisis. My colleague Aditi had mentioned in the beginning how China has been facing the property crisis. Interestingly enough, US too, lately, if you would have seen the numbers for housing starts, the building sales number, they have been down. So they are also talking about something interesting, that one needs to monitor these numbers quite carefully to understand is the economy that bad in a shape, especially when it comes to the housing market. Okay, now that we have talked about again in great details about how the countries have been doing, I think it's important to talk about how specifically EMs, the emerging markets, have been doing. And is the impact similar to the advanced economies or no? Of course, I'm sure everybody knows the answer. It isn't the same. EMs are at a much more difficult, have a much more difficult proposition to face, especially since they are still recovering from the COVID-19 pandemic. So that is one of the challenges. And on top of that, because the countries that are directly being impacted by the Ukraine war, IMF feels that there will be a long and a permanent damage to some of the industries associated with those countries. So that needs to be taken into account going forward. Apart from that, the high inflation for the emerging economies, of course, inflation is a challenge, but it's largely been related to the imported inflation that is being fed. And on top of it, the borrowing costs, of course, will be high because of the global rate hike cycle that is in play, and the capital outflows that we had mentioned about in the beginning. In addition to that, the emerging economies, the advanced economies are in a much more better position. Also, because they had given out a large fiscal support packages when the COVID-19 pandemic had hit those economies. Compared to that, emerging economies, for them, most of these packages are around fading away right now. And on top of it, the other global economic slowdown and those challenges have come into being. So IMF says that the shock of 2022, the three shocks that I had mentioned in the beginning, that will have a double global output loss of around 4.6% for 2024. So it is something that needs to be taken into account, especially when someone is talking about from an emerging market perspective. All right. Now that we talked a lot about what are the negative things that IMF have mentioned, IMF have been pointed out that there are some points that going forward are important to see, and what could be the future drivers of the global economy. Of course, it's important to keep an eye on the Russia-Ukraine war and the China factor. Of course, if the COVID-19 disruptions continue to play a role, the property crisis continue to play a role, it will further cause a supply side disruption, something similar that we had seen in the past, but would be a lot more aggravated going forward. In addition to that, there is a global rate hike cycle at play. So these are the 3 points that which were also important in terms of the shocks, but also something that needs to be watchful going into 2023 and 2024. The solutions that they have mentioned out in the report talks about that the global central bank should front load the monetary tightening cycle. That is, that they should hike rates, they continue to hike rates, or be open in their commentary about hiking the rates. And of course, the green energy transition. The energy transition basically talks about moving into the renewable, most of them tracking it and moving onto the renewable sites, using the renewable sources of energy more so. It's a critical importance at this stage right now, because as many of you would know that the Paris Accord that was signed in 2015 says that the global warming, that number for the global warming should be less than 2 degrees Celsius or somewhere around 1.5 degrees. However, to achieve that, IMF points out that the greenhouse gas emission have to be